so he's an investment manager for various people around the area and has plenty of experience, practical experience over the course of now decades, I guess it is, investing, trading, actually on the trading floor in San Francisco for a while. And he also employs, as I told you, he employs interns from UCSC. We've got Dylan, I know, is in Econ 133. Dylan, wave your hand. Dylan, I don't know if any of you know him. He was in 133 last quarter and has been interning. A number of other students have. So anyway, we'd like to welcome Thomas, and he's going to present for a little bit, and then you guys will be able to ask some questions.
Hello. Hi, everybody. I've been doing the internship program now at UC for 4 years, and in the back there are four interns that are either working now or have worked for me in the past. And Calvin, why don't you wave? Calvin's in San Francisco, graduated when?
December.
December, and he's working for me. He's basically doing everything that I do, shadowing me, kind of is specializing in marketing. Dylan's back there. Dylan was the regular intern last quarter and refused to go away and came back this quarter. Did such great work that I hired him a couple of weeks ago and has been doing amazing work. We're going to try to show you a little bit of what the interns do. And Kara is back there, the current intern for credit right now, and we're going to show a little bit of what Kara does so anybody that's interested in internship for my company can get an idea of what you're doing. I really want to thank Eric for the opportunity to talk to you guys. And I'm going to give you a little backstory on where I came from, how I got in finance, which was a strange path. I grew up in Florida, and I ended up dropping out of Florida State after my sophomore year and moved to San Francisco in 1978, intending to be a musician. And I was in a band in San Francisco from about 78. I was in a band all the way till 84. And in the day, as my day job, I was a typist. And I was a temp typist. I got sent from company to company. I did stints all over town, law firms, IBM for about a year, Crown Zellerbach, all kinds of different companies. And one day in 1981, I got sent to the stock exchange. And I got connected with a couple of brothers that were starting some companies. They were options traders. Options as a listed business started in 1976. Of course, the stock market goes way, way back, and options had traded, but as a listed security, options started in 1976 in the United States. And the Pacific Coast Stock Exchange, which has been around for 100 years or more, started an options floor, and my boss, Mike Gaiman, bought one of the original seats on that floor and started trading, and in 81 he hired me as a typist. And I like the environment. You're working on the floor. It's where everybody's screaming and yelling. The open outcry, the auction system, which is almost gone now. But I started working there when I was a runner. I ran pieces of paper from one place to another. It was before PCs had made their appearance. And my kids are always teasing me about the answer to almost every question is why daddy this, why daddy that, because you're old. And it's incredible that from 1981 to the way we do things now, really, my old job as a market maker, which I eventually become, the guys that stand in the pit, scream and yell, incomprehensibly to everybody else, but we're making sense to each other. That's gone just about. And the only place that still exists is really just for show. Chicago's got a floor and New York has a floor, but the majority of the trading is done electronically. But in 81, I started as a runner, and then I became a floor manager of a whole bunch of clerks. The company I worked for started growing really, really fast, and we were on the floor supporting the traders. They're in the pit screaming, yelling with badges and colored jackets. We would go grab the paper, input the data, bring a report to them, and that was my job for quite a while. In 84, my band broke up. I wasn't a very good musician. Main thing, our band was loud. We were one of the loudest bands in San Francisco at the time, but that was about the only way that we excelled. And I decided to try and apply myself more to the stock market. So I asked my boss if I could get a chance to trade. He said, you're going to be terrible at it, but I'll give you a chance because you've built up all this time. He didn't think I'd be tough enough to compete in the environment, which is really difficult because when you enter a pit and you're new, you're competing with all kinds of guys that are good at it already. And they don't want you there. If you succeed, you're going to take part of the money that's available in that pit. So they kind of haze you. And that usually works. And after about, well, my boss did let me, and he did something called backing me. He gave me capital, and he gave me a little bit of training. He wasn't really interested in training me, but he was a great trader. And I did learn a lot from him, but he really was kind of just doing me a favor because I put in 5 years. It took me about 9 months, and I almost got fired a bunch of times, but I eventually did learn to trade. And of the 100 or so people that probably started around my time, by the end of 9 months, I'd say 70 were gone, lost all their money, sometimes large amounts of money. My boss probably gave me about $100,000 in my account and expected me to make more than my salary, more than enough to pay him back and enough to pay myself. The amounts of money that professional traders make, the rule of thumb was you try to double your account every quarter, which is insane, right? But one thing I'll try to explain to you, that a professional trader, there's very little relationship to the amounts of money I can make for my clients, normal people, normal investors that I manage their money, and what a professional does. Part of the mandate and part of the mission of my company is, since I know what professionals get to do, all the tools they use and the advantages that they have, I'm trying to bring them over to regular people, and that's kind of something different that my company does that other companies don't do. We're trying to spread that out. It's working for a certain number of clients that I've got. We manage about 22 million now, which is a really, really small firm. Most firms are huge. But we're making good progress on that, and we're teaching clients to appreciate the kind of advanced trading strategies that we try to do. Anyway, I eventually went on my own. I worked for Mike for about 2 years. I did start making a pretty decent amount of money. And in the middle of '87, July 1st, I took my bonus, which was $25,000, and I used that as my trading capital, which was pretty weird. That I thought that I could replace, I was making about $40,000 a year in 1986, 87, and I thought that trading with $25,000 from my own account, I could replace my salary, which was pretty insane, if you think about it. But I did achieve it, strangely enough. Now, if anybody's taken a history course, they know that July 1st, was 4 months later, was the crash of '87, which was 23-point decline in 1 day. So if you extrapolate that to today's numbers, it's some crazy amount. I mean, things would, with today's press, and Twitter would explode, everything would go down. And living through that and surviving that was a pretty interesting experience. I was trading 6 stocks at the time. I was making markets in 6 stocks: AMD, Bankers Trust, Circle K, Rubbermaid, a couple of others I can't remember. And I had a strategy on called the back spread, which makes money if the market moves far in either direction. But I lose if it holds still. So I was back spread in 5 stocks, and I was just what's called naked long in 1 stock. The 1 stock I was naked long in was AMD. And it went, I think, from $23 on the previous Friday. It dropped from $23 to $9. And it overwhelmed all the gains I had, but it didn't put me out of business. I was still in business, and relative to everybody else, I lost a fraction of what I had made up to that point, but I was still in business and survived, which was major, because it cleared out a lot of people. There was a lot less competition after that. But I went on to have a really good and consistent career, built up my trading account. I brought my brother into the business, and I backed 3 other traders and trained them, and I bought a seat on the exchange. By the time I left in '96, I had saved a little bit of money, and I moved to Ben Lomond up in the San Lorenzo Valley and started taking it easy, playing a lot of tennis. So I didn't have enough money to retire. I intended to trade part-time, and I had a little bit of money that could pay some of the bills. But eventually, my wife and I met my wife on the floor of the exchange, which was great. She worked for the exchange itself. She was someone that enforced the rules. The traders are always trying to get away with everything in the pits, and there's a whole big staff that watches us and tries to prevent us from cheating, which some people did. So we ended up getting pregnant in 2002, and I went back to work, and I formed Win Capital Management in 2002, and I've been working on it ever since. Basically, my wife's my office manager. I outsource a lot of things, and I have various kind of institutional partners, but I'm running an investment advisory service. I'm a registered investment advisor. And one thing we'll talk about is the different makeup of advisory firms. Mine's a certain structure, and there's lots of different structures. So that's how I got into the business and how I started this business. I told you a little bit about my company. We think that we're different, and we're trying to do things differently. We're a B Corp. Has anybody heard of B Corp? It is a new structure. It's a legal structure, not a tax structure, and it's getting approved in state after state. It's trying to use a triple bottom line instead of a single bottom line. And so you get, there's an organization called the B Lab, and they certify you on 200 different metrics: environmental metrics, community service metrics, employee metrics, and try to turn for-profit companies into companies that are profitable but also have community and environmental metrics that they try to meet. So we got certified in January. I'm just like any other, there could be greenwashing. I'm sure there's companies that get certified and are as nasty as can be and try to be B Corps, just like there's green companies that are really not, they say they're green but they're not green. But we're attempting to embrace the letter and the spirit of that. And like I said, we're also trying to push out, really the overall thing I'm trying to do with my clients is to give them the benefit of the things that professional traders have and institutional traders have and affluent traders have. The technology is allowing us to bring those services down to a price that regular investors can have. And I think there's going to be a transition, and I'm going to try to be a part of that, so that people in general get to keep more of the money of the market. It's to just capture the returns of the market. The returns of the market will allow most people to save and to achieve their retirement goals. But the current industry captures so much of the returns. There's sometimes as much as half of the returns the market offers go to the financial services industry. And I'm trying to be a part of it that reduces that take for the financial services industry. If I didn't mention exactly, my job when I was on the stock exchange was as a market maker. Every price, and I've got some charts up here, and the charts are a 1-minute chart up in the upper left. And Dylan is kind of specializing in the trading software and the trading. And we're working on something called absolute returns. My clients are conventionally invested in general. We try to do a lot of things different, but in general, they're conventionally invested. And they're going to receive market returns. Last year, the market went up a lot. Aggressive clients that were really aggressively invested made returns that the market made. Conservative clients that just had bonds received what bonds. Moderate clients received a portion of the equity returns and a portion of the bond returns. But that 1-minute chart is what Dylan and I are looking at a lot, because we're trying to do things on top of the portfolios that won't disturb the portfolios from achieving their returns, but will add something, and absolute returns are returns that are disconnected from the market. We're trying to make positive returns in all market environments. And we go long the market, short the market, and neutral the market. And that little 1-minute chart is just looking at the SPDRs, which is the S&P 500 exchange traded fund. And it's something that we trade because it's most liquid, has the lowest commissions, less slippage, all kinds of other characteristics we like. And then over on the top right is the daily chart. It goes back about 1 year. And then the lower left is 3 years. And then this is the last 20 years of the SPDRs, which is the SPDRs just show the path of the S&P 500. And that shows to some extent that professional traders, and on my desk I have 6 monitors, and when I was on the floor we probably had 20 or 30 monitors, all different indicators, all different time increments. You look at the market a lot of different ways with lots of different studies to try to get oriented on a bigger picture. What's it look like? You know, over here it's pretty clear what's been going on. I'm not sure when you guys were born, but way back in '94, we had this crazy bull market based on internet productivity. We had the internet crash. We had the real estate bubble. We had the real estate crash, and now. I have the foggiest idea if we're at the beginning, middle, or end of this bull market. And I really don't care that much. We're very reactive. We are, that's a strong trend. And I don't know if today's the day it's going to reverse, or tomorrow, or when it is. But when it's like that, we draw lots of lines and we give this thing some room. And I'm not really going to panic about my clients' portfolios until this breaks its trend. And it is kind of at what we call a parabolic stage, where it starts going at a rate like last year. You can't sustain 30% rates. The population, earnings, there's nothing that's growing at 30% profitability that would reflect that kind of return. Last year's returns are the typical thing that long-term investors collect, because the returns are transient. They appear, disappear, good times, bad times. You know, if you started in '94 and just held on, you know, your path, if it was smooth, would, you know, go right through there. But because you have to get those returns, you have to live through all the headaches and the stress, and it's hard to do that. Very, very hard for any investors to stay through that. And what investment advisor's job really is a psychological job to try to determine if the client has the risk tolerance to deal with this. And I try to fit my clients in. I try to determine what the risk tolerance is and try to make them invested so that they'll stay put when this happens. And we do something that very few investors do. We do hedge our portfolios, which is what all professionals do, but very rarely done at this level for a registered investment advisor with a small amount of money. So we try to add as much value as we can, and we're, with the help of all the interns, we've been getting a little bit better. Mayday. And when it comes up, I'll show you. But I want to give you guys a little preview of things that interns do, if anybody's. There's one other firm, I think, called Sharp Investments, a big company managing $2 billion. They're a little different than us. They're really a pure money manager. They don't do financial planning. They don't have much interaction with their clients. They have big, affluent clients and institutions. And they also have a very, very narrow mandate. They're mostly a small cap value fund, whereas we have models for every type of investor, from conservative to aggressive and everything in between. And there's a million niches and a million different kinds of investment advisors. And when interns come in, I try to accomplish a few things. I try to expose them to short-term trading, long-term investing, the structure of the market, the pricing of financial services, and this comes up and goes into focus. I'm going to show you, I think for each of the 3 interns that are currently working, this is a database. This looks like, this is a database that Calvin's working on, which is, there's databases we all have that can find any 401k plan or any retirement plan in the nation. And we look in our area within 10 miles, 15 miles, 20 miles, we get a database of all the local companies. You can see all the companies up there. This is public information. Who's the top there? West Marine, Driscoll Strawberries, all the big companies that are around here either have 401ks or 403bs. That's the company retirement plan. And I don't know if it's there, but my company manages one, the 401k of New Leaf Markets, which has about 6 stores in Santa Cruz. And there's about 500 employees. They have about $3.5 million in assets. And it's a great client. I went in and competed with MetLife, Fidelity, Prudential, and ING, because I had a client that was a cashier there, and I saw her 401k and it was terrible, which is typical. 401ks are typically pretty terrible. One firm wins the job, and historically, when that one firm wins the job, they only offer the products and services that they create. So they don't allow access to the entire universe. They just sell their own products. So they get paid to be the advisor, and then they receive money for the products they sell. And it typically has evolved over time to be high price, low service, low returns. And companies like mine, through increased, because of technology, we're competing, and I basically won this job from ING, which is pretty crazy because they're giant, enormous. But they liked what I was selling, and our price was way lower and the service was way better. So this is an example of one of the things. Calvin goes into the software, crunches bunches of numbers, looks at all these different fields, tries to find if there's, looks on LinkedIn, sees if I'm connected to any of the sponsors, tries to find out if performance is bad. We sort this by performance, by fees, by all kinds of ways. We try to come up with a list that might be prospects. And then if I've got some kind of social connection, that makes the lead a little bit warm, and we see problems, either on price or performance, we'll go in there and see if we can capture the business, see if we can get a meeting, a proposal. So that's what Calvin's doing. That's kind of in the marketing area. And I think this is a little bit of what Dylan's been doing. Dylan specializes in trading and the trading strategies in the software. This is a back testing database. Dylan uses software to go back in time and look at the strategy over long periods of time, as many repetitions as it'll let us take. This is a little chart of a strategy. This is called a straddle. This is an option strategy, and that's kind of my specialty. Professional traders put this strategy on all the time, and the dollar gain is over there, and the percentage gain, and this is days down here. Or no, weeks, right? Weeks. So out of 20 weeks, 40, 60, 80, 100. If you did this over 120 weeks, a couple of years, that's the amount of money this thing would have made, except it doesn't include commissions. And that strategy is not possible except for professional traders. You're not even allowed to do that in IRA, because it's an unhedged position, has unlimited risk. Professionals get to take on unlimited risk because their bankers, the clearing firm or the brokerage firm that holds their money, knows that they understand risk and can manage it. And so a professional can do that. And I wanted to contrast that with this strategy is something that we're trying to do. It is profitable, but it has commissions and the additional positions necessary to make it legal for my clients. And this is typical of, this is Goldman Sachs, and this is us. The big firms, and this is going to be leveraged huge. They're not going to do it. This strategy takes about $5,000 to do, so this is amazing. $5,000 over even 50 periods, comes up here, 400% return. And this is how a lot of professionals make money. The options market has tremendous opportunity. They sell options. Options are pretty complex. Have you done options yet?
Next week.
So options are pretty interesting, and that's my area. But the money is made in options by selling options. Everybody's first instinct, if they ever have a trading account, is going to be to buy options, predict direction, and you'll lose your money eventually. And it's more difficult to figure out how to sell options, but this is a selling option strategy, which is where most of the professionals make their money. They all fine-tune it differently. But I think it's pretty interesting that once you try to apply a strategy in my environment with the rules that I have, it's much less profitable, although this is fine. But what Dylan and I are obsessed about, especially Dylan increasingly, but me, are the drawdowns. My clients will fire me if that happens. We could be up, for 2 quarters or 3 quarters of the year. But we run this on, we have to figure out the size that's appropriate for the clients. And I think that's like a $9,000 decline. So if I have a $100,000 account, the client's got $100,000 with me, and they lose $9,000 on one of my weird option strategies, and I tell them, well, you're still up $2,000 from when I started this. They're like, I don't care. You're gone. You have to know your client in this business, know your client, know their risk tolerance, and you have to size this. So we're going to reduce this for that size account, and we might do it halfway or a quarter of this size. And that's key to everything. And what the clients have, what the interns have learned is you kind of work backwards from not the profit, that's all well and good, the profit, but we work back on what's the worst case scenario. So we're going to try and do that. You can tell that it's, I think there's a, these are basically, that's isolating this graph, the lower graph, just all by itself, so it's standing out a lot more erratic. And that's the cumulative P&L of that thing. And then this is rolling returns. If you started 52 weeks ago, and just a random chance 52 weeks ago, you started in 52 weeks, you'd be there. But if you started at different points, 52 weeks ago from that point, there's a loss. So again, we've got to know this because I've got to know what I'm going to report at any one period of time for the clients. And they're very sensitive to the short term. You might show them in the long term, this makes money. But you'll get fired if you have too big a drawdown or a max loss. So I think those are the three. Oh no, there's one more. Basically, if I can find it, this you can't see this very good, but Kara did this, and one reason people don't do the things that we do is that it's very time-consuming and has all kinds of liabilities and labor costs. And there's no easy way for my portfolio management software to generate the profitability of our hedging strategies. My clients like to be hedged. Hedging means that I kind of put a floor underneath their portfolios. And for about the last 2 quarters, because of the previous graph that I showed you, I'm a little bit scared the market's going to decline. And the price of protection has gotten so low that I have hedged the accounts and put about a 6% floor. So for about 6 months, the clients have been hedged, but the hedge costs money. And that calculates the basis points or the percentage loss that they incur. And as long as that's pretty low, they like it. They don't mind investing with fractional losses. But if I hedge and I have bigger losses, their tolerance for that is less. So that's what Kara's doing. You have to pull out a ton of reports, do tons of manual calculations, and then put it in and she's pretty much doing that on a weekly basis, and that's one of the things that we end up doing. I was going to tell you quickly that I'm an independent. The industry is arranged in different structures. I'm independent. It means that I don't really share revenue with anybody or get told what to do by anybody. I can use any investment in the universe for my clients. There's something called a broker-dealer, which is about half as independent. They're kind of told what to do by a larger firm. They're part of the firm and part independent. They have some autonomy, and then in other ways they share revenue. And then there's the famous ones, Morgan Stanley, everybody you've ever heard of, Merrill Lynch. They're called wirehouses, and the representatives are really captive to the firm. The firm owns the client base. They take most of the money, but they give tremendous support and marketing to the representatives. I don't have that much more to go on this, and so I'm going to open it up to questions. If anybody has questions about it. Yeah?
Do you have a single strategy that you use for all your clients, or do you go with particular strategies for different amount of risks that your clients want to?
Everybody has different risks. There's 5 different risk categories, from aggressive to conservative, all stocks, all bonds, a lot. There's lots of rants and raves. I do it during the internships, but making money changed you. All of you folks, if you started making a ton of money, your personalities would change, and all of your politics and all kinds of things would change. You try to fight it to be a good person, but the pull of the dark side is strong. So the traders were really shunned by the staff, and the staff was where all the pretty girls were, and so I hung out with the staff. And I met my wife there. She was at work for the exchange. It took me a long ass time to get her to trust me. I met her as a trader. She got there in '89, I got there in '81. I was already an established trader. But no, I didn't have any interest in the frolicking that the traders did. I just wasn't into it. That wasn't my thing. I did different stuff. Anybody else? Yeah.
Do you hedge by short selling or do you use different?
Long and short. We hedge right now using puts, so we're long puts, which is kind of against my rules because we're long juice. And that's a bad way to be it, but the price, so we talked about the price of bonds and interest rates fluctuate. The price of puts fluctuates. So they're super low right now, so I buy puts. Otherwise, I short options against it in general. Do you have a question? Yeah.
What was the biggest challenge you had when you were being trained?
I'm basically a little bit shy to start out with, and my boss was the most honest guy in the world, one of the best traders in the world. But he didn't train traders. He gave money to traders, but he didn't spend any time. And he was, I don't know how to describe him because blunt doesn't do it, intolerant of a lack. I didn't give my best effort. I never really got serious. I got good pretty fast without trying that hard. I did outwork everybody, just tenaciousness, but I didn't go into all the ways you can make money. I didn't become a very good trader in many strategies. I had one strategy I was good at and I was fine. I made plenty of money. But my boss was very demanding and he almost fired me many times. So he wasn't really forthcoming with information. And I wasn't really good about breaking down his gruffness. And he wanted me to, follow him around and go to his, office and just wait until he was ready. Because you really didn't have time for most of the time. And a better guy, a more tenacious and a more goal-oriented person, and he would really got more information out of him. I eventually did late in my career. I wanted to leave the floor. And I got more serious, and I studied, and I developed skills at it's almost an infinite number of strategies, but I got better at that stuff. And I don't think I ever addressed it. In the managed money, I did, that was the worst year, was down 25%. And I had a $1 million client that started right at the top, almost the day at the top in '07, and he lost about $240,000, which is 24%. So, when you run out the numbers, they're huge numbers. That guy was amazing risk tolerance. All my other clients, I had to say, stay the course, chill out, you're appropriately invested, this is the transient things that happen. He kind of talked me down. I was like, dude, don't you think you want to take a little bit off the table? He's like, no, I'm in it. And he's an accountant and a CFO of a company, his wife's a CFO. He was throwing money. He's like, prices are low. He was, in his early 50s. He had the right attitude. That was great. And my best personal, I think I made $160,000 in one day on a trial. AMD and Intel were in a lawsuit. And I had brought my brother out in '93, he was an attorney, and I had him sit in on the court case in San Jose and follow the court case, and I thought he'd give me insight into what the outcome of the court case was going to be. I traded AMD options, and he was 95% certain AMD was going to win the case. So I made a big bet, which I never used to do. And they won the case, and the day the case was announced, I made $160,000, which was, my career was in the low six figures. I was not like the guys that, my boss and those guys made tons and tons of money. But I was real consistent. I took a lot of time off. If I sit down with a client, usually if they don't ask it, I'll tell them, why don't you ask me why I'm so smart, why aren't I rich? And basically I like time more than money. And so I took a lot of time off. I took 5 years off when I moved down to San Lorenzo Valley. And when I get time to go do stuff, I go do stuff. But for clients, I've gotten, as I've gotten older and I have kids, I've applied myself a little bit more now when it's other people's money. Anybody else? Yes?
Are you looking to hire interns right now?
We just had, an advisor found me that I think we're set. We hired Calvin and Dylan just in the last couple of weeks, and another person. We have to see if we grow enough. I sure hope we are in the market to hire somebody shortly, because without resources to market, like my strength, not marketing, I'm growing nicely, faster than my peers, just through referrals from my clients and a little bit of marketing. And Dylan's really taken over a lot of the day-to-day stuff, and I anticipate he's going to be doing more of that. This other advisor is a crazy qualified guy that currently works for BlackRock, which is the biggest money manager in the world, and he's got 10 years of experience and a Harvard PhD, which I can't stop saying, because I dropped out of FSU. I dropped out of Florida State, one of the worst, university systems around, and he's got a Harvard PhD. So I'm trying to come up with what it equals us added together. But I think I'm getting a contact degree from him. And I told him, he quit and he got some offers. I thought the offers were terrible, and he wrote some emails back, and I said something about the Harvard PhD, and he was really humble and everything about it. And I said, if I was a Harvard PhD, it would be every other word. I was the PhD, every other word. And I just know the guy, I'm using PhD every other word. We hope, we're going to keep going. The internship has been invaluable to me in growing the company and allowing me to do the things to grow the company, build the infrastructure to grow the company. And larger firms, a lot of times, will stop doing internships because they don't need interns anymore, and it's a pain to manage them when they've got staff now. But I find it tremendously fulfilling, and hope to keep doing this, forever going forward. So hopefully we'll grow. Sharp Investments is that other local company. They have 27 people, and we compete for interns. They always win, almost. And some people will want to work for me. I had one guy commit, and then he got offered. You got to go there. It's a great firm, and they hire all the time. So I'd love to be, in that position where you're growing and able to hire interns on a regular basis. But we just went from one person to 4 people. So we'll see if we can pay the bills. All right, I think it's time to go. I really appreciate it, Eric.
Yeah, well,
thank you, folks.
let's thank Thomas for coming in.